All right, folks, in the last episode, we dove into the global scene and sized up the U.S. economy. Now let's switch gears and check out what's going on with Japan, China, Germany, and a few other big players. So here's the scoop. In 2024, the IMF says Japan's GDP growth is going to be a whopping, drumroll please, 0.3%. Yeah, not exactly mind-blowing. If we break it down, Japan's economy is like that kid in class who's just meh at everything, barely passing. We're talking numbers bouncing between plus a little and minus a little, all hovering around that magical plus or minus 1% mark. But here's the twist. Even though the stats scream stuck in neutral, Japan's economy is actually on the mend. Now you might be thinking, wait, what? How does that make sense? Well, let me explain. Here's the thing. Japan's economy? Kind of warped. Like, not funhouse mirror warped, but definitely not your typical setup. Let's rewind a bit. Over the past 20, maybe 30 years, Japan's been stuck in this cycle of low domestic demand and deflation. What does that do? It shrinks profit margins for businesses. So what's the fix? The central bank decides to flood the system with liquidity, and the government goes, hey, let's just borrow like there's no tomorrow. Boom. Economy propped up, like it or not. Take their monetary policy, for example. Negative interest rates, been there, done that. But here's the kicker. The Bank of Japan has bought 760 trillion yen worth of assets. Let me put that in perspective. That's over $5 trillion. And you think the Fed is a big spender. The Fed's tally is under $7 trillion. But here's the crazy part. Japan's GDP is less than 1/6 of the US. And yet their central bank's asset buying spree is nearly on par with the Fed's. Wild, right? So here's what's really happening. About half of Japan's market is basically propped up by the central bank printing money like it's going out of style. It's like Japan's economy has its own set of rules. And honestly, after all these years, people kind of just roll with it. It's like, oh, Japan's economy? Yeah, that's the quirky one. Just subtract Japan from the equation, and the math works again. But hey, 2024 is finally serving up a plot twist for Japan. Check this out. Corporate profit margins are climbing, the stock market's on a roll, and, drum roll please, they've finally gotten what they've been dreaming of for decades. Inflation. Yep, the good kind, not the kind that makes everyone panic. So now the Bank of Japan is like, all right, it's time to phase out this Frankenstein-level policy experiment. For years, Japan's economy was running on a cocktail of government and central bank steroids. But in 2024, it's starting to stand on its own 2 feet. That's why, even though the raw numbers don't look all that flashy, the market's pretty bullish on Japan. IMF even projects their GDP growth to hit 1.1% in 2025. For Japan, that's like a personal best. Now, what makes Japan so different from everyone else is how it handles monetary policy. It's like they're reading the instructions backwards. While the rest of the world is cutting rates, Japan's cranking them up. But it's not because they love being contrarians. They're just, on a bit of a delay, like 2 years behind the curve. Think about it. A couple of years ago, when global inflation hit like a hurricane, Powell and friends at the Fed were in full panic mode, hiking rates like crazy. Everyone else was running for cover. Meanwhile, Japan, oh, they were living their best life. After decades of deflation, they finally got a taste of inflation, and they were like, more, please, bring it on. While the rest of the world was going, stop the madness, Japan was over here vibing, saying, let the inflation party rage on. Of course, the Bank of Japan isn't just going to let inflation run wild like a party that never ends. They're keeping an eye on the bigger picture, specifically wages. See, Japan's not going to hit the brakes on inflation until they see wages rising in tandem with prices, creating that sweet, sweet wage price spiral. Only then do they hit the rate hike button. Here's where it gets interesting. Japan's wages don't just go up because someone snaps their fingers. Enter Shunto, the spring offensive. Every spring, big companies and labor unions across Japan sit down for a nationwide showdown to hash out wage increases. It's like, spring's here, time to rumble. And the 2024 Shunto, it delivered the biggest wage hike Japan's seen in 33 years. That's a huge deal. And it's why the Bank of Japan wasted no time kicking off their rate hikes. They've already bumped up from negative rates to 0.25%, and the 10-year yield's now over 1%. The yield curve is finally starting to look, Well, normal. But let's not get too excited. Their balance sheet is still massive. Word on the street is they'll start shrinking it in 2025. Now here's the kicker. While the rest of the world is slashing rates, Japan's cranking theirs up. What happens when you're the odd one out? A flood of Japanese overseas assets starts flowing back home. That's great for Japan's financial markets. But there's a catch. If the yen strengthens too quickly, it could slam their exports. And you know Japan loves its exports. All right, that's the lowdown on Japan. Let's move on to the next player, Europe. When it comes to global economic growth, Europe's kind of the weakest link in the chain. For 2024, the region's expected to grow by a whopping 0.9%, and 2025 isn't looking much better, probably about the same. Now let's zoom in on Germany. Historically, it's been the rock-solid foundation of Europe's economy. But 2024? Germany's GDP is set to shrink by 0.1%. And guess what? This isn't its first stumble. Back in 2023, it already contracted by 0.3%. Here's the real kicker. Since the end of 2019, right before COVID hit, Germany's cumulative real GDP growth has been zero. Zilch. Nada. That puts it dead last among all developed nations. But here's the funny part. If you really want to nitpick, Germany hasn't technically entered a full-blown recession. Why? Because the textbook definition of a recession is 2 consecutive quarters of negative GDP growth. Now take a look at Germany's quarterly GDP over the last couple of years. It's like a seesaw, up a little, down a little, up a little, down a little. The problem, every time it goes up, it's barely a blip, and every time it goes down, it's a bigger drop. But technically, it hasn't had 2 back-to-back negative quarters, so no recession, right? Yeah, no one's buying that. Let's be real, Germany's economy is stuck in the mud, and everyone knows it. So what's dragging it down? Let's dig into the issues. Germany's economy took a massive hit from the energy crisis 2 years ago. That was like the first punch that knocked it off balance. Then there's the second problem. It's ultra-conservative fiscal policy. This is a big one, so buckle up. Germany? They don't mess around when it comes to budgets. While countries like the US would have been printing cash and throwing stimulus checks at everyone, Germany's like, nope, rules are rules. Their government's mantra is basically, we don't spend recklessly. Here's the backstory. In 2009, Germany passed something called the Debt Brake Law. Sounds intense, right? It is. The law caps the federal government's structural deficit at a tiny 0.35% of GDP. Yeah, you heard that right. 0.35%. That's stricter than a no-carb diet. And because Germans love their rules, they didn't just write this law on paper. They put it in the Constitution. That's next-level commitment. Now, not everyone in Germany is on board with this tighten the belt at all costs mentality. The ruling coalition, which is made up of 3 parties, is starting to crack under the pressure. Here's how the drama unfolded. You've got Robert Habeck, the economy minister from the Green Party, saying, let's tweak the Constitution and spend some money to boost the economy. Meanwhile, the finance minister from the Free Democratic Party, FDP, is like, over my dead body, fiscal discipline is sacred. These two couldn't agree, and things got so heated that in November, the whole thing blew up. Chancellor Olaf Scholz stepped in and fired the finance minister. Yep, history made. This was the first time a 3-party coalition in Germany completely spiraled out of control. And now, they've called for early elections in February 2025 to figure out this mess. What does this mean for the economy? Well, the writing's on the wall. By 2025, Germany will likely ditch its strict fiscal rules, run a deficit, and start pumping money into the economy. Buckle up, it's going to get interesting. Honestly, I think Germany's conservative fiscal policy isn't all bad if you're playing the long game. Tight budgets might look like a drag right now, but down the line, it could help keep things stable. That said, in the short term, yeah, it makes Germany's economic numbers look pretty rough. But fiscal policy isn't the only thing holding back Germany's growth. There's another big factor at play, population. Now, I know what you're thinking. Oh, great, another population problem. Didn't we just hear this about China and Japan and South Korea and even India? Now Germany too? And yeah, you're not wrong. It feels like every struggling economy these days is pointing the finger at population. But here's the thing. Germany's population problem actually has its own unique flavor. It's not just some broad, catch-all excuse. It really does help explain a lot of what's happening in the short term. Let me break it down for you. Germany's population dynamics are wild. It's got this massive baby boomer peak, people who are now around 60 years old. Back in the 1960s, Germany had a baby boom that hit harder than most other countries. And now, those same boomers are retiring en masse and leaving the workforce. Now, Germany does have a later retirement age, around 66 to 67. So technically, the full retirement wave shouldn't hit until about 2030. But here's the kicker. Even if these folks aren't officially retired yet, they're already in their 60s. Add in the fact that they've just weathered a pandemic and, well, how much productivity are you really expecting from them? Meanwhile, the younger crowd, the ones just entering the workforce, their numbers are steadily shrinking. So what does that mean? Germany's labor force isn't just declining, it's shrinking faster every year. And that explains two key trends. One, wages are rising quickly. Sure, part of this is the global inflation hangover, but a lot of it is straight-up labor shortages in Germany. Fewer workers equals more bargaining power. Two, productivity is slipping. With fewer people in the workforce and older workers slowing down, it's no surprise Germany's overall productivity is taking a hit. In short, this labor crunch is like a double-edged sword. Rising wages might sound great, but they're paired with a real drag on economic growth. And unless Germany finds a way to fill that labor gap quickly, this trend isn't reversing anytime soon. Take a look at this. U.S. productivity is chugging along like this, while Germany's looks more like this. Yeah, big difference. The global economy is going through a major transformation right now in Germany. Well, it's stuck in a bit of a pickle. Its industries are super mature, super fixed. There's not much wiggle room left. And on top of that, its labor market is aging at lightning speed. Those 50 and 60-something workers, they were the backbone of Germany's economic rise back in the day. Absolute legends. But now, that same aging workforce makes it much harder for Germany to adapt and pivot. Take companies like Volkswagen, Bosch, or even Deutsche Bahn. They're all laying people off. And here's the rub. These aren't just any workers. They're highly skilled specialists. But because Germany's job market isn't as flexible as, say, the US, these folks are having a tougher time finding new gigs. Bottom line, Germany's got some deep structural problems on its hands. Structural energy shortages, structural labor shortages, structural decline in demand for combustion engine vehicles. And let's face it, a structurally rigid government. When everything's structural, you're not just dealing with surface-level setbacks. These are issues baked into the system, which means any recovery is going to be slow and painful. Germany's in a tough spot, no doubt about it. That's a wrap for today, folks. Next time, we're diving into the economies of China, India, and a few other key players. So if you haven't already, smash that like button, hit subscribe, and don't forget to ring that bell so you don't miss the next one. Thanks for tuning in, and I'll catch you in the next episode.